In this question, you're told that Ziwani Limited is a company registered on 1st January 2015 and whose main business is the growing of sugarcane and processing sugar for the local market. You're given all those details there, additional information, and then you're required to compute the capital allowances due to Ziwani Limited for the year ended 31st December 2015. Very simple. Now, whenever you are told to determine the capital allowances, the order in which you should always do them is first by looking at investment deduction, and then secondly, it's industrial building deduction or allowance, and then thirdly is when we now look at wear and tear. Okay, so let's start off by looking at our investment deduction. That's going to be our first working. Now, investment deduction is always at 100% on the new machinery or any productive capacity related to the manufacturing activity. So what do we have here? Let's check and see. We have the sales there, we have expenses there. And expenses, do we have anything that has to do with the manufacturing capacity? There is nothing. So let's go and look at the notes. Note number 1 is on legal fees, nothing there. Note number 2, motor vehicles, again nothing there to do with the productive capacity. Let's look at note number 3. That's where now all the stories are. So computers are not, water pump is, furniture is not, sugar processing machine is, tractors are not, saloon cars are not, heating plant is, pickup motor vehicle is not. So let's start by looking at that. What are the assets that qualify? So the first one was water pump for 80,000. The second one was the sugar processing machine at 6.2 million. The heating plant at 2.3 million. Go to note number 4. Has to do with tractors, does not affect productive capacity. Note number 5, which has to do with a factory building. Now the factory building has to do with the manufacturing capacity, so we have to consider that. We are told that it constructed a factory building at a cost of 8.6 million. The factory building included showroom and a retail shop. Now this showroom and retail shop should not be included. So factory building. So we are going to take the 8.6 million and then we less this 1.2 and the 960,000, so which basically gives you 6.4. Okay, then we told that go down and staff quarters or constructed at this amount. This again has nothing to do with the productive capacity. I believe we are now done. Let's just quickly check and ensure we are through. Hey, there seems to be something omitted here. Machines and motor vehicles include 280,000 spent on the purchase of conveyor belts. This one I had misread. I'd seen as if it was motor vehicles, but it is actually relating to conveyor belts, 280,000. So let's have that. So let's add all of these up and see what they are totaling up to. We are getting 15.7 million. And we are seeing that the investment deduction is at 100%. Of the 15.7 million, which basically gives you 15.7. Okay. We are done with that. Let's now move to the second one, which is the industrial building deduction. Remember that with regards to the industrial building deduction, the default rate is 10%. However, for commercial properties, the rate becomes 25%. Let's see what we have here. What do we have here that meets the definition of industrial building? So from the income statement, anything here that looks like industrial building, there is nothing there. So let's go to the notes. Note 1 is legal fees, nothing there. Note number 2, we've already dealt with that under investment deduction. Note number 3, let's see. Computers is not, water pump is not, furniture is not, sugar processing is not, tractors is not, saloon cars is not, heating plant is not, pickup motor vehicles is not. So note number 3 does not include any industrial building. Let's look at number 4. Again, it has to do with a tractor. It is not an industrial building. We go to number 5. Number 5 says we have a factory building. So so the factory building was the factory itself, which you have already looked at separately. Now the industrial building will be this one, the showroom and the retail shop. So showroom, what is the qualifying costs? Showroom has a cost of 1.2 million. And we also have a retail shop, 960,000. Let's read through and see whether we have other aspects. Note number 6, yes, we have. It told that we have a go down and staff quarters. The go down is 2860, staff quarters 1620. So it's now a matter of determining the investment industrial building deduction. So commercial properties is the showroom and the retail shop. So for these ones, we shall use 25%. So 1.2 times 25%, 960 times 25%. So this gives me 300,000. And this gives me 240,000. Now the go down and the staff quarters are based on 10%. So this is 2860 times 10%, and this is 1620 times 10%. Now there was an additional complication in this scenario with regards to go down and staff quarters, in that they were not used for the entire year and you're supposed to prorate. Note number 6 says what? It says that they were put into use from 1st October 2015. So if our year end is December and we've started using them in October, means we have October, November, December, 3 months. So we have to factor in times 3 over 12 times 3 over 12. So what does that give us? So this gives us 71,500. This gives us 40,500. So when we add these up, we get that we have 652,000. That is our industrial building deduction. Finally, let's deal with our wear and tear allowances. Now for our wear and tear allowances, what we have to do is draw a table showing the various classes. So class 1, class 2, class 3, and class 4. Now class 1 is at 37.5, 30, 25, and 12.5. So we always start with our opening balance. Balance brought forward. Did we have any opening balance? We don't have any opening, so we can see assets are being acquired actually during the year. So let's just start from the top. Can you see any expenditure that seems to be capital in nature? So cost of gains, no. Sales salaries, no. Depreciation, no. Billboards for advertising, 250,000. That one seems to be capital expenditure. So let's deal with it. Billboards. Billboards would fall under class 4. Move on. Machines and motor vehicle repairs. Leave that. VAT on supplies, leave that. Directors' nominance. Legal fees, nothing there. Legal fees, nothing there. Machines and motor vehicle repairs include conveyors, nothing there. So let's look at note number 3. We have computers, 820,000. Computers are in class 2. We have water pump, which we ignore. Water pump was part of the investment deduction, manufacturing capacity. We have furniture, 250,000. Don't have to include it. It is class 4. Ignore that. We have tractors, which are heavier moving, class 1. Then we have 2 saloon cars valued at 4.8. Remember, there is a restriction on saloon cars. So for the saloon cars, I'm going to take a restricted amount, which is equivalent only to 4 million. Heating plants, we have already considered that. So pickup, 8.6 million. So then you're told something about a tractor that was disposed of. So So this is under disposals now. Let me just make that neat. Going to so let's add them up and see what we have. So let's now compute the wear and tear allowances on these based on the rates that we had set out above. So class 1, class 2, class 3, and class 4, okay. So the totals, when I add all of these, okay, so with that we have calculated all the capital allowances due to Ziwani Limited. Let's now solve for the second part of the question, a statement of adjusted taxable profit. So we start with the reported net profit, which was 4180. Then we add back any of these expenses that was not a valid or an allowable expense. So cost of cane was allowable, salaries was allowable, depreciation is never. So 120,000 add back. Billboards is capital in nature, so again should not be recognized as an expense. That one is valid. VAT is not valid. Emoluments are valid. Legal fees generally are valid unless they are adjusted. Let's look at the notes and see. We're told that legal fees comprised the following. So we have parking fees, collection of debts, stamp duty, settling a dispute with a customer. Now, fines are never allowed, and neither are the stamp duty on land because it's related to a capital transaction. So we have to add those up back. So the fines of 120 and the stamp duty of 480. Then total machines and motor vehicle repairs, so these are expenses, included the conveyors, which we capitalized to 80. This is from note 2. So we need to add back all those, which basically when I add them up gives me 3050. Let's now less any incomes that should not have been they should not have been added, as well as any adjustments that we may have come across. So let's go fast through. Look at the incomes. Sale of sugar is okay, molasses is okay, profit on disposal of tractor is not okay, 560,000. So capital gains tax is not applicable. Discount received is business related. What about the dividends from Ukulima Cooperative? These are separate incomes, and other income should not be mixed with business income, so we're going to isolate it. 1.2. Then now we deduct capital allowances that we had already worked out. So we had investment deduction, we had industrial building deduction or allowance, and we had wear and tear. So let's just get all these deductions from our first part. So 15,700, 652, 6071. Those are the three numbers. $15,700, 652, 6071. So this gives me 24,183. And when I work it out, 4 million plus 3 million minus 24 million gives me a loss of 16,953,000. This becomes an adjusted loss, and this is what the examiner expected from us in this question.